Hello, this is Mike Swanson of WallStreetWindow.com. I'm speaking with Ike Iossif, who runs the website marketviews.tv. How you doing today, Ike?
I'm doing good, Mike. Thank you. How about yourself?
Oh, I'm doing great. We did an interview a couple days ago about the S&P 500 and the U.S. stock market, and I'm going to link to that so people can go over that. And we were talking about what it might be doing over the next year. But today we're going to flip and talk about gold. You are basically one of the top gold timers in the world, according to Timers Digest, and I can attest to that fact from the interviews we've been doing over the past couple of years. So I've got the charts you've sent me for gold, and I guess we'll just get right to it.
Well, Mike, the first thing I would like to do is actually go back to the beginning of the year, because since the beginning of the year, I have said, and people who have been listening to us throughout the year will remember this, I have said that if gold was starting a new leg in the bull market, then what we would see would be a pullback lasting into the early fourth quarter of the year, and then we will see the real advance. Now, since then, what has happened is this. We have had a sharp advance from January until July. That is actually a 7-month advance. Now, normally speaking, there's two things that, in my experience on technical analysis, are important. One is time, duration, I should say more accurately, and the other one is pattern. What I mean by that is this. Let's say that, for example, we're talking about a double bottom, okay? Now, if the first bottom has taken, let's say, 4-6 weeks to form, then the second bottom should take pretty much the same time. You can't have the left bottom taking place within 4 to 6 weeks and the other one taking 40 weeks. Then we're not talking about double bottom. We're talking about something else.
Yeah.
I don't know what it is, but something different. Okay. So duration during which a pattern completes is just as important as the pattern itself. Okay. Now, we had a 7-month advance from January until July. So when you get a 7-month advance, usually you can get anywhere between a 3 to 5 month pullback, especially in the beginning of a long-term up leg. Wave B tends to be rather nasty. So to have, a pullback in the neighborhood of 60 to 70, 75%, both in terms of price and time, is not unusual. But that is about it, okay? If you look at the first chart that we have for today, which goes back to the long-term double bottom we had back in 1999, then we can observe several things that are important. First of all, we can see that gold rallied up to the declining tops line. If you connect the highs in 2011 and 2012, you get a declining tops line.
Oh, yeah.
Okay, and that puts us between 1380 and 1400. All right? So gold declined right at that point. At the same time, if you connect the lows in 2001, 2002, and 2015, we get the long-term uptrend line, whose support is somewhere between 1100 and 1125. And that is where gold is at right now. So this chart, which is a long-term chart of gold, right at this moment is kind of neutral to bearish.
Well, one thing about I just want to point one thing out real quick, because that 1400 level was also the high of 2012 and 2013.
Yes.
So I think it's a key mental area too. Like you're just like 300 was in 2002. Like on that chart, you can see 300 was the top in 2001 and 2000 also. And when you broke 300, you, of course, it went crazy for years. So I gotta suspect 1400s like that.
Well, right now, we can paint two different pictures. If, let's say, the bullish argument is still alive, then gold has to stay above 1100, 1125. Now, in that case, if you draw a parallel line starting from the top in 2011, okay, then one can argue that we are right at the bottom of a rising channel, and the top of that rising channel is over 4,000. All right, that's one side of the argument. The other is, if we break below 1100, then that would mean the long-term uptrend line going back to 2001 is violated. If that is the case, the minimum downside target is actually 1,000. And right now, gold is right at that critical point, because starting from July up to now, we have had a 6-month pullback. That is unusual when you have a 7-month advance. At most, it should have been about 5 months, okay? And we're talking about almost a 78% retracement. That is also kind of unusual for wave B. And if you look from a short-term point of view, once gold broke below 1190, the short-term trend became bearish. When it broke below 1175, the intermediate term turned bearish. And if it breaks below 1100, then even the long term will turn bearish. All right. So this chart, to me, is very important, because right at this moment, it shows how critical it is for gold to hold around 1125, 1100. If it does, and it rallies strongly from here, then the bullish argument that what we have had was an A, B, C type of movement. The rally was wave A from January until July, though wave B was from July until December, and then we're starting wave C, which will last about 12 to 18 months. But for that to happen, I said we needed to hold for above 1100 and 1125, and the time is critical. Mm-hmm. Now, I think right at this moment, gold has run out of time and has run out of price support. If gold is going to turn around, it will have to do so within the next 5 to 10 trading days. Otherwise, it would look at 1,000. Now, the next chart is also a long-term chart of the US dollar. Throughout the year, I have stressed that the chart in the dollar pointed to a head and shoulders formation. And if it was concluded, then we can have a very dramatic rise in the dollar. Looking at this, the dollar is very close to resistance around 105, 105 and a half. From a shorter point of view, it is also in an upward trending channel. And the upper limit of the channel is 120. That's nearly 16% higher where it's at right now. Mm-hmm. So it could, if the dollar tops out around 105, then 105, 105 and a half, then I would expect gold to bottom somewhere where it's at right now. But if the dollar, breaks above 105, then it could quickly, climb up to 110. That would translate to about 1,000, 1050 to 1,000 in gold. Above 110, then we're looking at around 800 for gold. If the negative correlation continues to hold, which I don't have reasons to believe that it won't. Okay, there are times, short periods of times, where the negative correlation has not held, but the majority of the times it has. So until proven otherwise, you have to assume that it will continue to hold. Now, the next chart is also a long-term chart on the yield for the 10-year treasuries. Now, we can see that a very important resistance point is right around 3, okay? We have had a similar rally in 2012, which exhausted itself at 3%, once the yields got to 3%, okay? So we're not very far from it as we speak. We're about 2.346. So it could, if yields pull back around the 3% area, then we can also expect the dollar to pull back. But any further rise above 3% in the 10-year, in the yield for the 10-year treasury, I think it would spell trouble for gold and more gains for the dollar. The next two charts that we have, they're proprietary. We have spoken about them before. I usually show them once, sometimes maybe twice a year. There are inflows, outflows analysis charts, and what they are, they're proprietary indicators based on 25 and 50-day basis of the cash inflows and outflows into the XAU stock components. The black line represents the inflows. What I mean by inflows is the total dollar volume on the buy side. The red line is the outflows, which is the dollar volume on the sell side, okay? And the green line is the 50%, which is the point where inflows and outflows are equal, and therefore we're at equilibrium. When inflows exceed 50%, obviously buyers exceed sellers, and that is supportive of higher prices, and the opposite holds true if outflows exceed 50%, means sellers outnumber buyers, so that is supportive of lower prices. The encouraging sign is that both the 25 DMA and the 50-day DMA of outflows versus outflows is right at the equilibrium point, which is 50%, which is neutral. At the same time, we have had a positive divergence, which is supportive of the idea that selling pressure has been exhausting itself, okay? I want to make one more comment. Knowing, because I have developed these two indicators, I can tell you this much. When we are approaching a major support point or a major resistance point, it is not unusual for this indicator to turn to the equilibrium. What it means is, yes, most of the selling or most of the buying is exhausted, but if you get a breakout or a breakdown, then you could see renewed selling or renewed buying, okay? So the fact that we have had a positive divergence and these indicators are at equilibrium is somewhat encouraging at this moment for gold bulls, but if long-term support was to break, then I would not rule out renewed selling pressure. Okay, So to put it all together, Mike, right now gold is at a very critical point. It has broken the short-term support, it has broken the intermediate-term support, and now we're at long-term support. If that does not hold, then we can kiss goodbye the bullish scenario for gold for the next year or so. So it would be important for people to keep monitoring what is happening with price, and then perhaps we'll talk about it again the third or fourth week of January.
Yeah, and honestly, we've been speaking all year. And in August, it wasn't shocking to me that we would see a correction. You, as you mentioned earlier in the interview, were looking for a drop into the fall, but not one that would necessarily last as long as this one has, for the bullish scenario to play out. And then, of course, it's fallen more than I thought it would, and the bullish scenario suggested, and here we are. And last year, the gold was weak into the December Fed meeting, and then rallied into the end of the year, and did well this year. But this time, it didn't rally immediately after the Fed meeting. It's not trading exactly the same as it did back then, and I'm not sure what it's going to do. But it seems to me like what it does, and your analysis is showing this over the next, few weeks is going to really tell the tale in it.
Yeah, listen. I mean, it could very well be that we are right at the bottom of a historical move, or right at the beginning of a historical, decline that will take gold below 1,000. The point is, you need to keep, you need to pay attention to what is happening if you're interested, in gold, or if simply you're interested in trading, because one or the other will provide, great trading opportunities, whether you short or long.
Mm-hmm, mm-hmm.
But I do want to emphasize that gold is at a very critical point, having violated the short-term trend and the intermediate-term trend, and being at long-term support right now. This is, the last chance for gold to make a stand.
Well, we'll have to come back and see where things are situated at in a couple weeks after New Year's. Hopefully, if you're around to do an interview and see what's happening.
Well, I would like to wish everybody happy holidays and a happy new year.
You too, Ike. It's been a fascinating year this year. I mean, with gold, we had a massive rally that was fun to be a part of. That's for sure. And the stock market has been getting more and more interesting too since the election of Trump. And as you one of the most interesting things, of course, the dollar rally. But this 10-year Treasury bond chart, I think, is very fascinating. So we've got all kinds of markets situated to make all kinds of moves next year, and to be on top of this, because it's not just gold that provides trading opportunities, but this bond move could be historic also.
Oh, absolutely, absolutely.
Well, thanks for talking to me and everyone else, and I'll talk to you next year.
Thank you, Mike.